Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.
All right, so welcome to Mortgage Mom Radio. I'm Debbie Marcoux. I am the Mortgage Mom, and today I want to make this show all about you. I want to answer your questions and make sure that you get the information that you need. So if you have questions about anything that at all that is real estate, mortgage, credit, so do you have credit issues that you'd like to discuss, or you would like some tips or pointers how to fix those? Are you having issues with property taxes? Did you just recently purchase a home and you've got a supplemental tax bill? You're not exactly sure, what to do with that. I want to answer those questions for you as well. So please, once again, this is going to be a very interactive show. I want to make sure that I get the information to you that you need. Please do not hesitate to put those questions into the feed. I will read them out loud and I will answer them for you. While I wait for everybody to jump on, I'm going to go ahead and run a quick commercial. And as soon as I get back, then I will get into it. So now if I do not get questions from anybody, then I am going to go ahead and I'm going to start talking a little bit about credit today. I'll talk a little bit about property taxes because that has come up. Some closing costs, I'll run into a little bit of that. So if you are all too shy to ask your questions, don't worry. I've got good, valid information to give you guys. But in the meantime, I'm going to go ahead and throw a quick commercial up right now. And when I get back, we'll jump on in. So stay tuned. We'll be right back.
Oh, is it time to go for a ride? Hold, please. Let me grab a few Road Sodies to go. Our newest collection, Road Sodies, is a tribute to all of those die-hard passengers enjoying the dunes and mud while the captain does all the work. We have tees, hoodies, and hats to help you show off your style. This design just launched. Be the first to grab yours today and show up to your next adventure in style. RVRmoms.com.
All right, so welcome back. I can see while the River Moms was running, the commercial was running, I can see that Lori jumps on. She says hi and thank you. So Lori, you are very welcome. I do want to tell you guys that River Moms is actually my son's company. He has come out with all of the designs. So of course I have to try to give him a little plug. It is really a very cute shop. It's all for boaters and off-roaders. If you guys like to go take your razors into the desert in the winter, or you like to go boating in the summer. So it's all around that. I'm actually wearing one of his shirts today. You guys probably can't see it, so I'll sit up a little bit, but it says, there we go. There we go. All right. So River Moms, partying right since forever. And so we certainly have been. I love my boating season, and you've definitely got to be a good, fun mom to be doing that. So just want to give him a little plug, but let's get into it. I can see my dad jumps on. He says howdy. So Dad, thanks so much for being there. Again, I want to remind everybody, this is a very interactive show. And today I do want to make it all about you. I want you to ask your questions. I want you to put those questions into the feed. One thing I do want to mention is that this is streaming on Facebook as well as YouTube. And for my Facebook watchers or followers, for whatever reason, I have not been able to see the Facebook comments for a couple of weeks now, for a couple of shows that I've done. And I'm not exactly sure why or why I'm not seeing those questions. So if you do ask me a question and I do not read it or answer it for you and you are on Facebook, I'm going to apologize right now. I will go back to the Facebook stream and I will actually reply to those messages when the show is over. Or obviously you are more than welcome to jump off of Facebook and come join us over on YouTube. And I can see those comments on YouTube. So please feel free to do that as well. So The Barclay Group jumps on. She says, hi, all. So, Barclay Group, thanks so much for joining. And again, I want to let everybody know this is interactive. I want you to ask your questions. So until that does happen, I'm going to go through a couple of scenarios of things that have come up here recently with my clients who have come across, obviously working with me on either a refinance or on a purchase. And so one of those things that has come up, and it comes up quite frequently, are property taxes. And so I do want to talk about that. They are part of closing costs. They are part of ongoing costs that you do have as a homeowner. So I want to get into that. You've got supplemental property tax bills that can come up. You've got your regular property tax bills. It's part of closing costs when you go to actually close on the home. So I do want to make sure that we discuss what you should be anticipating and how you should be handling those property taxes. So the number one thing to keep in mind is that property taxes, 90% of the loans that we close, the clients choose to have property taxes included in their mortgage payment. I do highly suggest this because it is something that you make a mortgage payment every single month. And as time goes on, the property tax bill comes out and the bank that you are making your mortgage payment to, so your lender, your servicing lender, they will pay that property tax bill for you on your behalf. So you never have to worry about a big bill that you receive that all of a sudden that you need to pay and that you weren't prepared for it. So one thing to keep in mind is if you want your mortgage to be that way, that is called impounding or escrowing. And you want to make sure that you let your mortgage lender know that that's how you would like your loan set up. Now, for somebody that has a loan already and they did not set it up that way, that is okay. You can still get your property taxes and your homeowner's insurance if you'd like, or just one or the other. You can get those included in that mortgage payment. All you need to do is call that toll-free number on your mortgage statement. You want to talk with their escrow department. It might be labeled as escrows with the servicing lender. Sometimes they're called impounds. They can be interchangeable. They're interchangeable words. So you can call your mortgage company and ask them to include it. They are going to ask you for money up front. So we need to talk about that because that's the part of closing costs in a purchase, or even adding those property taxes later. There is a bill. And what is that bill and why is it there? So with your mortgage, when you impound into your payment, the taxes and the insurance, or one, or just, or both, when you impound, when you escrow those bills, we need to make sure that we have enough money to pay the next bill that will be due at the time that it is due. So let's just say, for example, the majority of the people that are watching the show are from California. So we're going to talk about California for right now because that's where the most of my listeners are. Now, obviously, every single state has a different day of the year. Sometimes it's twice a year. Sometimes it's quarterly. Sometimes it's 3 times a year. Sometimes it's once a year. So where my dad's at in Illinois, he is a once a year bill. If you are in Nevada, they are quarterly. They're 4 times a year. So in California, your property taxes are due twice a year. Your property taxes are due on March the 1st, and they are due on November the 1st. So we, depending on when you close on your loan or when you want to add those taxes and insurance to your mortgage payment, we have to look at when is the next bill due, how much will be due, and then what month are we in and how many more mortgage payments will you make before that tax bill is due. So for example, today's date is April the 23rd. So your next mortgage payment, if you already own a home, would be May 1st. If you are purchasing a home and you are closing on that home this month in April, your first payment will not be due until June 1st. So for somebody that owns the home already, May 1st. Next bill that is due will be November 1st. So they have a May, June, July, August, September, October. They have 6 monthly payments that they will make before the next property tax bill is due. Now, we also need to make sure that there needs to be a cushion in that account. So most mortgage lenders will want there to be a 3-month cushion. So we know we have a 6-month bill that will be due November the 1st. We know if you own the home today and you want to get them added, you don't have them in your current payment, we know you're going to make 6 monthly payments before they are due. Now, we're not going to count the November 1st payment that you will make because the bill has to be paid before November 1st when you would make that payment. So we really have May, June, July, August, September, October. So we have 6 months that you'll make payments. 6, okay? And we need a 3-month cushion. So when you go to impound that loan, they're going to send you a bill and say, yes, we will increase your monthly payment. We will make your property tax payment for you in November, but we need you to send us a check. And that check is going to be for 3 months worth of property taxes to establish the account to get the cushion. Now your monthly payments that you make will continue to be separated, principal and interest to the bank. The taxes and the insurance, or just the taxes or just the insurance, will go into your separate escrow account. And every month when you make a payment, they're going to set that money aside. And when November comes, they're going to make the payment due, and you're still going to have your 3 months of cushion. So that is for somebody that owns a home today. Now, if you are purchasing a home and you are including your property taxes and your insurance in your monthly payment, then we're going to have to collect money up front. So once again, if you closed on your loan in April, so right now, April 23rd, today's your closing date, as an example, your first payment will not be due until June 1. So we now have June, July, August, September, and October. We can collect for 5 months, but we're going to have a 6-month bill that will be due. Plus, we need that cushion of 3 months. So we're going to actually collect from you your cushion of 3 months plus 1 more month that you're going to be shy in payments that you make. So we're going to collect 4 months of property taxes up front as part of your closing costs. So what is 4 months of property taxes? Well, if you're in LA County, for example, average property taxes are 1.25% of your sales price. So that's average. And I can see that Why Not jumped on and said, almost on time. Hello, all. So Why Not? Thank you so much for joining. So let's just say that you guys buy the home, you purchase the property for $800,000. 1.25% would be $10,000 that is due per year on that property. This is on average. Some homes have supplemental taxes that are added to that 1.25% on top. Some have Mello-Roos. I've seen property taxes as high as 2% in Los Angeles. Again, if you guys are listening from another state, my dad needs to get the heck out of Illinois, but his property taxes are much more than 1.25%. Texas, you guys are well above 1.25%. You're about 2.8%. So believe it or not, California property taxes are actually not the lowest in the country. There's actually a lot of states that have better property taxes than California, but they are not by any means the highest like they are in every other category. So let's just say that's $10,000 a year for an $800,000 property. So you can see that if I'm collecting 4 months worth of property taxes from you, so now I'm going to take that and I'm going to divide by 12. So that's $833 a month, and we're going to collect 4 months. That's $3,333. That's part of your closing costs. So a lot of people don't understand closing costs, and they don't understand how are they adding up so quickly. Okay, well, now we've got $3,333 that we're collecting just in property taxes. We haven't jumped into homeowners insurance yet. Homeowners insurance, you have to have an entire 12 months policy paid at the time of closing. But then we also need to have an additional 2 months for the cushion of the insurance. So now we're collecting 14 months on your homeowners insurance. Well, homeowners insurance can be quite pricey. Right now, for an $800,000 property, you're probably looking at about $250 to $300 a month in Los Angeles. So if we take $300 a month and I have to collect 14 months worth of your homeowner's insurance, that's $4,200. So now we're at $4,200 up front, plus $3,300 for taxes. We're at $7,500 in closing costs, and we haven't even gotten to title, escrow, appraisals, recording fees, any of the other things that jump into closing costs. So another issue that I've run into lately where people, number one, haven't understood their property taxes. We've done refinances and they're confused about upfront impounds. We've done purchases. They're confused about upfront impounds. They don't get it. So I'm trying to explain it right now. I also have people that are going into escrow that know that they've got their down payment, but they had no idea how much money that they were going to need for their closing costs and how much the closing costs were going to be. So I want to make sure that you guys understand that closing costs are another percentage of what you owe on top of your down payment. So that's very important. It's very important to understand. Closing costs in general, and this can be across, the 50 states. It's going to change a little bit by city, county, and state. But on average, closing costs will run you about 1.5% to 2% of your sales price. So now that you can understand that depending on the month that you close and depending on how many monthly payments there are until the next property tax bill is due, you can see how closing costs can change. So it is very difficult for a loan officer to give you an estimate. You're going to need X amount of dollars. And then you go out and you start shopping for homes and it takes you 3 or 4 months to get into escrow. That number could change based on the month that you close, when the next property tax bill is due, and how much needs to be collected up front. So just keep that in mind. Now, another thing that is big with property taxes that comes up quite frequently, and I do get these phone calls, and so I want to make sure that you guys hear this: supplemental property taxes. What are they and why do you get them? So in some states, for example, Nevada is one of the states where you will actually inherit the property taxes from the seller. So you don't necessarily get reassessed when you purchase the property. There is some reassessment that is done, but it is very different than what we might see in other states. So again, speaking to California and reassessments, you are reassessed on your property taxes based on the price that you purchased the property for. So if your seller bought the home for $500,000 and now today you're buying the home from the seller for $1 million, what the property taxes are for that home for your seller is much lower, basically half of what your property taxes will be. So where does these supplemental bills come from and why does it turn into a big, huge issue down the road? So number one, the supplemental property tax bill is from the tax assessor. It's from the county assessor. So let's just say, again, you're in Los Angeles County and the LA County tax assessor is going to reassess your property. They're going to get to they're going to get to this. They're going to get it done, but it's going to happen within 12 months-ish of you closing on your home. So it might happen. I've seen it happen within 2 or 3 months. I've seen it take 15 months. So when they reassess the property during the whole time you've owned the home, up until they do the reassessment, the property tax bill that you have been receiving is what the seller paid. It is not what you are supposed to pay. So then what happens is you get reassessed. Okay, that could be 2 or 3 months. That could be 15 months. It's going to be somewhere in that range, right? So now you're going to receive from the county a supplemental tax bill. They're going to tell you, well, you paid $5,000, but you were actually supposed to pay $10,000. So now you owe us $5,000 if you're following. Now, obviously, it depends on how many tax bills went by that were paid during the time that you were waiting for them to do that reassessment. So what you owe could be not very large at all if they did the reassessment very quickly, or if it took them the time to get to the reassessment, you might end up owing a pretty penny. Now, here is where the buyers make their mistakes. and they make big mistakes and they don't know that they're making mistakes. So we're going to talk about that. When a mortgage lender does the job that they are supposed to do, when we qualify you to purchase the home, we make sure that we are calculating what we believe we are going to see, or actually what you are going to see in your property tax bill once the reassessment has taken place. So once you've been assessed, we're calculating that we believe that your property taxes are going to be $10,000. When we set up your mortgage, if you include your property taxes and your homeowner's insurance in your monthly payment, or even just the property taxes, when you include it in the monthly payment, we are calculating your monthly payment based on the assessed value. So what we believe that your reassessment is going to show. So every month you make a payment and you haven't been reassessed yet, and you make a payment and you haven't been reassessed yet, and this could go on for months. Okay, well, many times we see this, it takes place within about 12 months that they get the reassessment done. So what happens? Okay, your mortgage lender is required to do an audit of your escrow account once a year. By law, they have to audit your escrow account. The taxes that they pay are based on the bills that they receive from the tax assessor. So if they're getting a bill for $5,000, even though it's supposed to be $10,000, they're paying $5,000. You're making a payment based on the $10,000. So you're doing right. The bank isn't necessarily doing anything wrong. They're paying the property tax bill that they're receiving. At the year mark, they're going in and they're auditing your account. They're auditing your escrow account because they're not allowed to keep more than the cushion that we talked about at the beginning of the show. They're not allowed to keep more than that cushion in that account. They can't keep your money. They have to, by law, give it back to you if they've over collected. So what happens is that they look at the property tax bills that have come in. They look at what they've paid out. They look at your balance in your escrow account, and they determine that they're holding too much of your money, that they're collecting too much money from you every month. So the job I did as your loan officer, setting up your payment to be accurate and correct, the bank will say, we're going to send you back $5,000 because we charged you too much money, and we're going to lower your monthly payment because we've been collecting too much money from you. So you get this check in the mail. It's a $5,000 check. It comes from your escrow account. It comes from your servicing lender, and they say, oops, we're so sorry. We've been over collecting. We're lowering your monthly payment on your house by $400 a month. And here's a $5,000 check. Well, you don't think that your bank would have done anything wrong. So you cash your $5,000 check and you start making your lower monthly payment, and you are ecstatic. I mean, this is like $5,000 you didn't expect to have and a $400 payment that's cheaper, and you are so excited. And then the next thing you know, the tax assessor finally gets to it and they send you a $5,000 bill. And you don't have $5,000 to pay the bill for the supplemental tax bill. The money's no longer in your impound account because the bank sent it back to you because they weren't allowed to keep it. And more, on top of that, it gets worse. Your monthly payment just went down by $433 a month. So the monthly payment that you're making is not enough to cover the next tax bill of $10,000 when the bank gets it. So what you need to do in that situation, and I hope that I'm helping to educate you in how it happens, what you need to do when you buy a house is if you get a check, a refund check in the mail, no matter what it is for, number one, you pick up and you call the bank and you ask them, is this for my impound account? How much were the tax bills that you paid? Then you pick up the phone and you call your lender, your actual loan officer, not the servicing bank that's taking your monthly payments, but the expert that you worked with to get you set up for your mortgage. You call them, you call me, you call Heather, you call whoever it is that you dealt with, and you say, how much are my property taxes supposed to be? Is this right? Should I cash this check? They're lowering my monthly payment on my mortgage. Is that okay? And that's when we're going to tell you, no, it is not okay. Let's dial that toll-free number together to that servicing lender, to the bank, and let's get them on the phone and let's talk. And we're going to have a conversation with them about how they need to put your payment back to where it was. And we're going to have a conversation with you about putting that money that you got, that refund that you received, putting it back, putting it in a savings account. You cannot send it back to your escrow account. They can't legally take it. But you are going to put that into a savings account and you are not going to touch it because you are going to get a supplemental bill. And you are going to have to pay that supplemental bill. And that is the only property tax bill that you will ever receive as a new buyer that you are going to be responsible to pay, not the bank that you make your mortgage payment to. So I hope that I explain that in a way that it makes sense. I want to make sure that everybody understood that. It is a pretty big deal. I also want to make sure that if you have questions about it, that you do throw that into the feed, throw it into the comments, and I will make sure that I, answer it for you. Please feel free to call my office and talk with me, get an appointment, get me on the phone. Let's discuss your impound account. Let's discuss your escrow account. Let's make sure that everything is flowing, especially if you haven't been in your home for very long. In Texas, it's a big deal. If you buy a brand new home from a builder, your property taxes are going to be based on the land value. That actually happens in California as well. It happens in many states. And your property taxes are going to be super low until it finally gets reassessed as an actual house. And that could be a big, huge shock. In Texas, let's give you guys an example. You buy a property, you can buy it cheaper than California, right? Absolutely cheaper than California. So let's say you get that beautiful home, $600,000 in Texas from that builder. And your property taxes are 2.8% of your sales price. So you've got, and I'm not saying that that's everywhere Texas. It honestly depends on the county and the city, but that's a very average common number that we use when we're very quickly putting numbers together for a new client until we have the address of what they want. So at 2.8%, those property taxes is $16,800. Well, imagine what can happen to your impound account or to your escrow account with your mortgage lender if they're getting property tax bills that are a couple $100, not what should have been being collected. Now, all of a sudden, you get a supplemental bill. You've already gotten a refund. You've already spent the refund. Now you owe $16,000, your monthly payment. So what happens to your monthly payment in the situation that you get the refund and you spend it? And then they also lower your monthly payment. So they're not collecting enough. What happens? What happens to you? So let me explain it. So you're at $16,800 that you owe in Texas on that $600,000 property. You got a refund check, you spent it, and the mortgage company is not collecting enough to cover the future tax bills, right? Let alone the one that now you're responsible to pay. So we've got $16,800. And what's going to happen is they're not going to know when you get reassessed. They're not going to know that there's an issue until they get the first bill for $16,800. So now you're already a year behind. So you owe $16,800 in your escrow account. You don't have enough money. You've got maybe $300 or $400 in there. Maybe you've got $500 in there. So what happens? So the bank is going to pay that $16,800, but they need to now get money from you for 2 years. The 1 year that you were behind that they just paid out. And then obviously they've got to get enough to cover the next year to make sure they get enough to get you out of the negative and then back into the positive for the next property tax bill that will come due. So they're going to collect $1,400 a month just to pay the bill that's behind. Then they've got to get enough from you to get the bill that's going to come next year covered. That's another $1,400. So your mortgage payment just went up $2,800. $2,800. Your mortgage just went up on a $600,000 property. That will absolutely devastate a family. It will kill a family. It will put you in a position where you have to sell your home. You can't come up with the difference. You can't make the mortgage payments. It could ruin credit. You could end up in foreclosure. And a lot of people want to blame the loan officer for that, when in reality, the loan officer, if they did their job, and the mortgage company that you went through, if they did their job correctly, they started you off with the correct payment with the $1,400 a month. But if the county didn't get you reassessed and didn't get a tax bill to the lender before your 12 months was up and your audit had to legally happen, and you got a refund and then you spent it, that's on you. If you didn't call your loan officer back and say, why did I just get a refund? That's on you. If the lender, the mortgage loan officer and the mortgage bank that you went through at your origination did not set up your monthly payment correctly and worked off of the property taxes that were for the vacant land, they are not a very good mortgage lender. And that is not something that we are supposed to do. That is not how we are supposed to put together a file. Have I seen it? I absolutely have seen that before. I have seen it take place. It does not happen very often. It is absolutely not a company that you should be working with. But let's explain why people work with those companies. So you call me and you get a quote for your new mortgage that you'd like to know what's your payment going to be. And I give you a number that's $1,400 more expensive than lender B that you talked to a week ago, or that your builder told you to call and told you to work with, and they're a $1,400 payment cheaper. Why would you come to me when you could get a payment that's $1,400 cheaper? So there's always a reason behind. If something sounds too good to be true, it is. And you need to question it, and you need to ask, and you need to call us and try to get a second opinion. I do have some chats coming in, so I am going to read them. I've got Why Not says, I'm a bit lost, so I'm going to clarify. Even after you've paid closing costs, which include insurance and property tax every year, you're still going to need an extra $10,000 a year to pay. No, that is not correct. He said that those annually. Is that correct? So I was just giving examples that if your property tax bill is $10,000 and you get $5,000 refunded back to you from the bank because the tax assessor hasn't reassessed your property yet, then don't spend the $5,000, because you're going to have to pay that $5,000. You're going to get a supplemental bill the very first year for what didn't get charged, and you're going to have to pay that bill. It is one time and one time only that the supplemental bills come out. And then the next one was Michelle says, can you use the same numbers and tell how much of closing costs are tax deductible? So property taxes are tax deductible, yes. You want to talk to your CPA to get that answer. I am not a CPA, so I cannot legally answer that question of how much per year can you write off of from your property taxes, just like I cannot legally answer how much mortgage interest can you write off per year from your tax returns as well. But that is definitely something that your CPA can answer. Yes, property taxes are a write-off. You can take them. The dollar amount maximum that you can take, you need to confirm with your CPA. And mortgage interest is also tax deductible, and the dollar amount that you can write off per year, you also need to speak with your CPA. To give you an example on mortgage interest, and this is why I cannot answer this question. Mortgage interest you can write off on a primary residence or a second home, and you can write off up to $750,000 in loan balance per year. However, some people have a 5% interest rate. Other people have a 2% interest rate. Somebody else has an 8 or a 9% interest rate. So the interest that somebody pays on a loan balance of $750,000 is going to be completely different from person to person to person. The other situation, and again, I just can't answer your question, Michelle. You have to call the CPA on the property taxes. Is that I don't know if there's dollar amounts that can be written off based on your total annual income. So if you're in different income brackets. So again, call the CPA when it comes to that. Okay, now Michelle says, I meant the commissions, the fees. So are you talking about selling a property and then or buying a property and the commission and the fees that you pay? And if that is the situation, yes, if you pay a commission or a fee to sell the property, that is something, again, that the CPA is going to look at the closing statement and they're going to determine what the cost of sale was or the cost of purchase was. And they're going to reduce that from the total overall gains of the property. And then she said, mortgage interest and property tax, I know, are tax deductible. So she meant commissions. And so, yes, those are something that can be taken off of the cost basis of the home when they are determining what your tax liability is. What did it cost you to either sell or purchase the property? So definitely that would be a CPA question of how it will affect your overall taxes that you owe. But yes, those items, commissions and fees are tax deductible. And so she says buying. So again, with buying, the property taxes that you pay, the interest that you pay, if you pay any fees, if you pay any, commissions, you're going to give that closing statement to your CPA and they're going to talk with you about what is tax deductible and what is not. Points that are paid to lower interest rates are considered mortgage interest. And so, yes, those are tax deductible as well. Okay, so I don't see any other questions that have come in. It looks like I can see Facebook if I jump into a different multi-stream button that I've never seen before. So go figure, there was probably some sort of an update to the system that I was not aware of. So my mother-in-law jumped on, Karen. She says, great, comfortable shirts. Thank you so much. So again, I mentioned to you guys that my son has a website. It's called River Moms. So it's rvrmoms.com. And if you are a boater or you are an off-roader, if you guys like the side-by-sides, the dirt bikes, the pontoon boats, the wake surf boats, the cats, all the fast stuff, if you're coming out to Desert Storm, you'll be able to see all that stuff. But River Moms is the website, rvrmoms.com, and they are super fun. So Michelle says, can you deduct all of the fees in the year of purchase or you have to amortize them? So again, Michelle, you're asking me CPA questions that I cannot legally answer for you. Your CPA and even Google can probably get you the answers that you're looking for. I can't tell you exactly what you can or you cannot write off. If I give you that information and I'm not a licensed CPA, I can get into big, huge trouble when you think that you've got something that's tax deductible and then you go to write it off and then you're told no. And then you're like, but the mortgage mom said I could. So I can't tell you exactly when can you write it off, if it has to be amortized. I do know a lot of things, but I don't know everything. And I would hate to give you information that is inaccurate. One thing when it comes to a rental property to keep in mind is that rental properties, you guys are going to do depreciation on rental properties. That's going to be over a certain amount of years. When you pay points on a refinance, it's different than points on a purchase. So points on a purchase is considered interest that was paid in the year that you bought the home. So that is 100% completely tax deductible, the points paid. But when you do a refinance, if you pay points, those are going to be amortized. So there's so many different rules and such that I just don't want to put my foot in my mouth, and I'm legally not allowed to answer the question. So again, you guys got to keep it to real estate questions, mortgage questions, property taxes, credit, anything that you might have questions about that I can answer. I'm absolutely going to answer, and I will try my best or at least guide you where to call. So for Michelle, I would definitely recommend calling the CPA to get all of the very specifics down that you need before you make a decision to buy or to sell. So I don't see any other questions that are coming in. It is 1:38. I've been on here for about 39 minutes. I try to keep the show to around 30 minutes or so because I think for people that are watching the show at a later date, that's kind of the tolerable amount of time that they're willing to stick around and listen and get information. If you have any questions that you would like me to answer and you didn't get an answer today, please feel free to go to my website. Go to mortgagemomradio.com. There is a contact us button. You are welcome to email me at Debbie, DEBBIE, at mortgagemomradio.com. Ask me those questions, you guys. If they're great questions, I'll bring them up in the next show so that everybody can hear them. But if you didn't get an answer to something that you've got going on, please feel free to reach out, schedule an appointment. If you go to this website, there is an appointment button that you can book an appointment to speak with me. So again, that's mortgagemomradio.com. You guys can call me. It's 844-935-3634, or send me an email to Debbie, DEBBIE, at mortgagemomradio.com. I hope I gave you guys some good information. Please share this if you've got a friend or a family member that is in trouble with their impound account. It might help to explain a little bit further in detail. And they could possibly, if they were really in a bad spot, they could possibly refinance to try to get caught up on what they're behind in the property taxes, and then to get themselves set up into a more a favorable monthly payment before they would get behind on mortgage payments or feel like they had to sell. There might be some options that could be there. So share this with them, and please tell them to feel free to reach out to us at the office. We're here to help in any way that we can. So once again, 844-935-3634. That's 844-WE-LEND-FOR-YOU, WELEND, and the number 4. And that's it. I will talk to you guys all. I'll be here again next Wednesday at 1 p.m. And I hope you guys all have a fabulous rest of your week. Talk to y'all real soon. Bye-bye.
Debbie Marcoux is licensed by the Department of Financial Protection and Innovation under the California Residential Mortgage Lending Act, NMLS ID 237926. Also licensed in Arizona 0941504, Florida L076508, Georgia 69178, Idaho MLO 208023796, Illinois 031.0058339, Missouri, North Carolina I210940, Nevada 57237, Oregon, Tennessee 184373, Texas, Washington MLO 237926.
She's the mortgage mom. She can get things done when you're in need and don't know where to go. Pick up the phone and call mom.